BlackRock just quietly helped move an enormous amount of money across global markets, and almost nobody is paying attention to what that really means. I'm not talking about internet rumors or scary thumbnails. I'm talking about documented record flows into specific ETFs and regions that can change how your portfolio behaves over the next decade. In this video, I'm going to walk you through where big money is rotating, why it is happening now, and how regular investors can respond without panic or hype. By the end, you will understand the logic behind this shift, so you can build a calmer, more intentional strategy instead of reacting to every headline. Let's start with scale, because if you do not feel the scale, you will underestimate both the opportunity and the risk. BlackRock is not just another fund manager. It is the largest asset manager on the planet, with total assets recently hitting around $14 trillion. Through ETFs and index products, it has exposure to almost every major market, sector, and region you can think of. When an ecosystem that large tilts even a few degrees toward or away from a theme, the ripple effects spread across retirement accounts, pension funds, and brokerage portfolios worldwide. In 2025, global ETFs and ETPs saw record flows, crossing roughly $2.3 trillion in net new money, eclipsing the previous record set just a year earlier. A big chunk of that did not go into traditional US-only exposure. BlackRock's own Flow and Tell data shows record inflows into European equities, renewed appetite for emerging market debt, and equity, and strong demand for ex-US developed markets. In plain English, a lot of new money looked beyond the US for returns, not because America is over, but because concentration risk in US megacaps became too obvious to ignore. Why does this matter to you? Because markets do not reward loyalty, they reward positioning. If your portfolio is 80 to 90% U.S. large cap, just because that is what felt safe in the last cycle, you might be anchored to yesterday's winners while big money quietly prepares for tomorrow's. Institutions rotate based on policy, currencies, and growth data. Retail investors often rotate based on fear and FOMO. So let's look at the scoreboard. In recent years, we have seen non-US exposures from parts of Europe to select Asian and emerging markets post strong double-digit returns in local terms, and they have attracted record inflows as investors chased that performance and a weaker dollar tailwind. When your home currency softens or becomes less dominant, foreign assets can benefit twice. Once from the underlying stocks, and again from favorable currency moves. That is the double engine effect of global investing that most first-time investors never think about. You might be wondering, does this mean I have to become an expert in 20 different stock markets? The answer is no. You do not have to become a full-time stock picker in 20 different countries to participate. Broad ETFs are the main tools institutions use to express these views. For example, large emerging market funds allow investors to own diversified baskets of companies from fast-growing regions like Asia and Latin America, instead of trying to guess a single winning country. Other funds target developed markets outside the US, like Europe or Japan, which have seen renewed interest due to structural reforms, currency dynamics, and changing corporate behavior. When you buy those ETFs, you are essentially hitching a ride on the same macro themes institutions are pursuing, without having to pick one stock or one politician to bet on. Now layer on politics, because this rotation is not happening in a vacuum. No matter who is in the White House, markets care less about personalities and more about predictability. Geopolitical tension, tariff risk, and fast-changing policy can all increase volatility, especially in globally exposed companies. Historically, elevated geopolitical risk has gone hand in hand with higher defense budgets and strong order books for aerospace and defense companies, which is why investors are watching that sector closely. You do not need to cheer for conflict to acknowledge that governments around the world are boosting defense spending and reshoring critical supply chains. Global military spending has surged into the $2.7 trillion range, with the United States alone approaching nearly $900 billion in annual defense outlays and other major economies stepping up as well. Research on defense trends shows that budgets for drones, cyber defense, space, and advanced weapon systems are projected to keep growing through this decade, even if other line items face cuts. That spending shows up as revenue and earnings for certain companies, and that is one reason the defense ecosystem is getting more attention from both policymakers and investors. Politics creates the headlines. Capital chases the budgets. While all of this is happening on the equity side, something just as important is changing in the plumbing of the financial system. How gold is treated. Under Basel III endgame reforms, taking full effect around July 1st, 2025, allocated physical gold held in bank vaults has been elevated to Tier 1 high-quality liquid asset status. That means banks can now count it at 100% of its market value for certain key liquidity reserves, placing it on equal footing with cash and top-rated government bonds in the regulatory hierarchy. For years, gold was treated more like a niche hedge subject to haircuts and lower capital treatment. Now, in regulatory terms, it sits much closer to the center of the system. That shift is huge for demand. When regulators tell large banks and institutions, yes, you can treat this as top-tier liquid collateral, it changes the incentive to hold it on the balance sheet. Under earlier Basel rules, bullion was effectively penalized. Under the endgame package, that penalty is gone, and gold, and in some interpretations, even certain silver holdings, qualify as the highest quality collateral alongside sovereign debt. At the same time, central banks have been consistently increasing their gold reserves over the last several years, adding hundreds of tons and reinforcing gold ROS role as a core reserve asset rather than just a crisis toy. Put together, you get a world where gold is both a psychological safe haven and a formal building block in the banking system. So, what is the playbook for someone watching all of this from their phone or laptop, trying not to get whiplash from every headline? First, recognize the difference between panic and positioning. Panic is selling everything on a headline you do not fully understand. Positioning is deciding in advance how much exposure you want to. US large caps, non-U. S, developed markets, emerging markets, commodities like gold, and more defensive sectors such as healthcare, utilities, and defense. Second, understand that every global rotation feels uncomfortable in real time. When flows into ex-US assets and commodities hit record highs, usually means early movers have already acted, and the story is just starting to show up in mainstream coverage. Waiting for total certainty often means buying after the easy part of the move is over, when prices already reflect most of the good news. Third, you do not need extreme bets to benefit. Most investors are better served by gradual rules-based changes. For example, shifting a small percentage of a portfolio from highly concentrated US megacap exposure into broader global or thematic ETFs, or adding a modest allocation to assets that benefit from higher geopolitical spending or stronger commodity backdrops. The key is to size positions so that market noise does not push you into emotional all-or-nothing decisions. Finally, remember this. Markets are designed to keep you overstimulated. The flashing red numbers, the alerts, the doom posts, they all encourage you to trade more, not necessarily to build wealth faster. Real wealth transfer happens quietly when impatient investors hand over assets at bad prices to patient ones with a plan. In part 2 of this script, we are going to zoom in on the specific sectors and ETFs that sit at the center of this rotation, from emerging market baskets to defense contractors and gold-linked funds, and we will break down the exact risk points you need to understand before you put any fresh cash to work. So far, we have talked about the big picture. Trillions rotating through ETFs, money quietly leaving pure US megacaps, defense budgets marching higher, and gold being promoted inside the banking rulebook. Now let S get into where that money is actually going and what that might mean for someone sitting at home with a normal brokerage account. The first lane is emerging market ETFs. BlackRock ADS data shows that out of the record $2.3 trillion that went into global ETPs in 2025, a meaningful slice landed in emerging market equity funds. One flagship emerging markets ETF, built by BlackRock, with more than $130 billion in assets, has taken in almost $6 billion in just a single recent month, putting it on track for the biggest monthly inflow since it was launched. Strategists describe this as part of a broader rotation out of US, only exposure into cheaper, faster-growing regions. Why are investors this interested in emerging markets right now? One reason is simple: price relative to growth. After a decade where US megacaps dominated, many emerging market indexes trade at lower earnings and book multiples, which makes them look cheap compared to their long-term growth outlook. Another reason is currency and interest rate dynamics. When the dollar softens or becomes more volatile, financial conditions in many emerging economies improve, and local currency returns for dollar-based investors can get an extra boost. If you open up a broad EM ETF, you are not just buying one country. You're usually getting exposure to China, Taiwan, India, South Korea, Brazil, and a mix of other economies across Asia, Latin America, Eastern Europe, and the Middle East. Some of these markets are plugged into global tech and manufacturing supply chains. Others are tied to commodities, demographics, or infrastructure booms. The point is not that every single country is perfectly positioned. The point is that as a basket, these regions give you access to growth engines that do not move in lockstep with US large-cap tech. Of course, there are trade-offs. Emerging markets come with higher political risk, weaker institutions in some places, currency swings, and at times less liquid markets. That is exactly why institutions tend to use diversified ETFs rather than single-country bets. They spread those risks across many economies, so any one blow-up is less likely to wreck the whole position. So if your current portfolio is almost entirely US focused one way to line up with what big money is doing without being extreme, is to carve out a small slice of your stock exposure and move it into a broad, low-cost emerging markets ETF. You're not trying to guess who wins the next decade country by country. You are acknowledging that more of the world's growth is happening outside the US, and you want a measured stake in that, sized so that volatility does not knock you out of the game. The second lane is defense and security. If you want to know what governments really care about, do not listen to speeches, read the budgets. Global defense spending is now measured in the trillions, with estimates putting total military outlays above $2.5 trillion and on track to rise further toward $2.7 trillion in the near term. In the Indo-Pacific, plus a massive push into cyber, space, and autonomous systems. What does that look like in practice? On one side, established contractors are building fighters, missiles, ships, and armored vehicles. On the other side, newer tech-driven firms are working on drone swarms, laser weapons, hypersonic missiles, and AI-enabled surveillance, and they are starting to get a bigger and bigger slice of procurement budgets. Reports on defense tech trends describe high single-digit annual growth in areas like defense electronics, radar, communications, and space-based surveillance over the next several years. For investors, this shows up in two main ways. First, broad aerospace and defense indexes have outperformed at times when geopolitical risk was rising, as multi-year contracts lock in revenue and order backlogs swell. Second, there are now specialized ETFs that bundle these companies into a single ticker, giving you exposure to the whole ecosystem instead of forcing you to guess which contractor wins each contract. There's an obvious ethical layer here. Some people simply do not want to profit from defense spending, and that is a valid decision. Others see it as part of reality. As long as governments are spending heavily in this area, the economic impact will show up in earnings, share prices, and indexes. From a purely financial angle, the right question is not, do I like war? The question is, do I understand that trillions are being directed toward defense, and do I want a small, tightly controlled allocation that reflects that structural spending trend? You do not need to load up on defense stocks to acknowledge the trend. Even a modest allocation to a diversified aerospace and defense ETF can give you a way to participate, while the bulk of your portfolio stays in more traditional sectors. The key, again, is sizing, enough to matter if the spending boom continues, but not so much that one policy shift or contract delay derails your overall plan. The third lane is gold and gold-linked products. We already talked about the Basel III endgame reforms, but it is worth slowing down and looking at what they really change. As of July 1st, 2025, physical allocated gold that meets certain conditions is officially treated as a Tier 1 high-quality liquid asset. That means banks can count 100% of its market value toward critical capital and liquidity ratios, with a 0% risk weight, putting it on the same regulatory shelf as top-rated sovereign bonds. Under older Basel rules, bullion sat in the lowest tier and carried a 50% haircut, making it capital inefficient for banks to hold large positions. The new treatment removes that penalty and effectively tells banks, if you want to hold gold as part of your liquidity toolkit, we will not punish you for it. That one rule change reshapes liquidity management and reserve diversification, and it nudges banks and asset managers to treat gold as a serious part of their safety bucket, not just a speculative side bet. You can already see the impact in flows. Data from the World Gold Council shows that global gold ETFs saw their strongest flows on record in 2025, with holdings rising and daily traded volumes jumping across exchanges like COMEX and the Shanghai Futures Exchange. Some analyses estimate that gold ETFs pulled in close to $90 billion in net inflows in a single year, and even historically weak regions for gold investing, like parts of Europe, flipped from outflows to sizable inflows. At the same time, central banks remain consistent buyers. In recent years, they have added hundreds of tons of gold to official reserves, citing diversification away from fiat currencies and a desire for assets that are not tied to any single government's promises. When you put regulatory upgrades, central bank buying, and ETF demand together, you get a different picture than the old gold is just something doomers hoard in basements narrative. Gold starts to look like a mainstream, capital-efficient hedge that sits right next to cash and treasuries in the global plumbing. That does not mean gold is a straight line up. Academic work on safe haven assets shows that gold is a useful but imperfect hedge. In some crises, it shines. In others, it lags behind government bonds. It can be volatile over shorter windows. It does not generate cash flow like a business or a bond. But if you look at how regulators, central banks, and large investors are treating it after Basel III, it is clear gold has migrated from emotional hedge toward structural building block in many portfolios. For a regular investor, the toolkit here is straightforward. If your goal is safe haven exposure, the cleanest options are physical bullion that you control with proper storage, gold ETFs that closely track the spot price and hold allocated metal. Gold miners, on the other hand, behave more like leveraged equities. They can outperform when gold is roaring, but they bring company-specific risk, operational risk, and stock market volatility on top of metal prices. If you want stability, miners are usually a secondary play, not the core. So let's put these three lanes side by side. On one track, you have emerging market ETFs capturing record inflows as investors look for cheaper growth outside the US. On another, you have defense and security stocks riding a global rearmament cycle that shows up directly in government budgets. And over in the safe haven corner, you have gold being upgraded by regulators, accumulated by central banks, and accumulated via ETFs at record pace. You could treat each of these as a separate hype cycle, or you can see them as different responses to the same underlying world. A world where growth is more dispersed, geopolitics matter more, and people are less comfortable trusting any single government or sector with all their wealth. From here, the question stops being, which one is the magic answer? The better question is, given these shifts, how do I build a portfolio that has some exposure to global growth, some exposure to hard security, and some exposure to hard money, without turning my entire life into a single macro bet? In the next segment of this script, we will talk about exactly that. How to turn these themes into a simple structure with percentages, bands, and rules so you can quietly benefit from the rotation instead of being bounced around by it. Now, let's turn this from interesting story into an actual structure you can use, because ideas only help if they translate into positions and percentages. A simple way to think about everything we have talked about is the core and satellites approach. In this framework, your core is the boring, diversified foundation, usually broad global equity and high-quality bond ETFs that you plan to hold for years. The satellites are the targeted positions you add around that core to capture specific themes like emerging markets, defense, or gold. Most guides from big asset managers and ETF providers suggest that the core should still be the majority of the portfolio, often something in the 60 to 80% range, depending on your risk tolerance. That core might be a global stock ETF, a US total market fund plus an XU, S fund, and a mix of bond ETFs for stability. The satellites, in total, then make up the remaining 20 to 40%, the part designed to tilt you towards specific opportunities without taking over your whole plan. Inside that satellite bucket, you can divide the roles. One slice can be your emerging markets exposure, the part that gives you access to cheaper growth outside the US. Another slice can be a defense and aerospace ETF, the piece tied to rising global security spending. A third slice can be gold and possibly a bit of other precious metals, the safe haven and liquidity component. The exact weights are personal, but the structure helps you think in categories instead of random trades. So how might someone actually size this in practice? Different research pieces on asset allocation and precious metals talk about ranges rather than magic numbers. For gold, several portfolio studies suggest that something like 5 to 15% of a diversified portfolio in precious metals, with gold as the majority of that, can improve risk-adjusted returns without dominating everything. Conservative investors might be closer to 5 to 10%. More aggressive or inflation-worried investors might go higher, but anything much above that becomes a concentrated macro bet. For emerging markets, some core satellite examples put EM equity in the range of a few percent up to the low teens, depending on how global your core already is. If your core is heavily US tilted, you might use a slightly larger EM satellite to bring your overall exposure closer to the world market weight. If your core is already global, you may only need a modest EM tilt to feel the impact. Defense is usually the smallest of the three because it is a narrower theme and carries political and regulatory risks. Reports and model portfolios that use sector satellites often keep individual sector tilts in the low single digits. Enough to matter, not enough to break the portfolio if the theme underperforms. In practice, that might mean something like 2 to 5% in a defense-oriented ETF, sitting alongside other sector or factor tilts. Whatever numbers you land on, the crucial step is to write them down as ranges, not as one-time guesses. Core satellite guides talk about setting target bands. For example, emerging markets 5 to 10%, gold 5 to 10%, defense 2 to 4%, and then only acting when your allocations drift outside those bands. This does two things. It turns volatility into a rebalancing signal instead of emotional noise, and it stops you from constantly tweaking things because of every headline. Rebalancing itself can be rules-based and boring. Some investors check once or twice a year and bring positions back toward the middle of their range. Others only rebalance when something drifts more than a certain number of percentage points from target, which reduces trading and taxes. The point is that you decide the rule when you're calm, and then follow it when markets are not. Now layer back in the flow story. Global ETF flow reports from 2024 and 2025 show that investors have already been using this kind of framework in aggregate, cutting some exposure to crowded US tech, adding to international and EM equity, rotating toward defensive assets, and increasing allocations to gold products. You do not need to chase every move, but you can use those flows as a sanity check. If your own positioning is wildly different from what the largest, most informed players are doing, you should at least understand why. There is also a psychological benefit to thinking in terms of core and satellites. When you know that 60 to 80% of your portfolio is in broad, diversified core holdings, it becomes easier to tolerate volatility in the more focused satellites. You are less likely to panic sell an emerging markets ETF after a scary headline if you can see that, in total, it is only 5 or 8% of your net worth and sits next to safer assets like cash, bonds, and gold. Another helpful mental shift is to think in decades, not quarters. Core satellite strategies are designed for long-term, planned investing, not for guessing next month's CPI print. The themes we have been talking about, global growth rebalancing, persistent defense spending, gold's new role in the banking system, are multi-year, even multi-decade forces. They will have noisy years and quiet years, but the structural direction does not flip every time the news cycle does. Finally, it is worth saying what this approach is not. It is not a promise that emerging markets will always beat the US, or that defense stocks will never have drawdowns, or that gold will always save you in every crash. It is a recognition that the world is bigger than one country, that government spending choices matter, and that safe haven assets are being formally woven deeper into the financial system. If you build your portfolio around those realities, with a strong core, clearly defined satellites and written rules for how you size and rebalance them, you give yourself something most traders never have, a plan that survives more than one cycle. In the last part of this script, we will walk through a couple of simple example setups at different risk levels, so you can see what this might look like in real numbers. Now, let's make this concrete with a couple of simple example setups, so you can actually picture what this looks like instead of just nodding along in theory. These are not recommendations, just illustrations of how people use a core and satellites approach with themes like emerging markets, defense, and gold. Imagine a more conservative investor first. They care about growth, but they care more about sleeping at night. Guides on core satellite portfolios often put them around 80% in the core and 20% in satellites. In practice, that might look like 80% in a mix of broad global equity and high-quality bond ETFs. For example, a world stock fund plus a short-term bond fund to keep volatility down. 20% in satellites, split roughly as 8% in a diversified emerging markets ETF, 4% in a defense and aerospace ETF. 8% in gold, mostly via a physically backed gold ETF or allocated bullion. Those numbers are just one blueprint, but notice what is happening. The core still dominates, and the satellites are small enough that no single theme can wreck the plan. The gold slice is on the higher side of the typical 5 to 10% range that many conservative and moderate allocation guides suggest, which fits someone who is more worried about shocks and wants extra ballast. Now imagine a more growth-oriented investor. They have a longer horizon and can tolerate bigger swings, so they might run closer to 60% core and 40% satellites. A possible structure there could be 60% in a global stock ETF and a smaller anchor in government bond ETFs, enough to keep some stability. 40% in satellites, like 15% in emerging markets equity ETFs, 7% in a defense and security ETF, 8% in gold, and perhaps a small silver position, 10% in other themes they believe in, like broader commodities or specific sectors. Here, the gold share might be nearer the low to mid single digits relative to the entire portfolio. If they want to stay more aggressive, which is in line with how some aggressive profiles keep gold around 5% or less to prioritize growth assets. Emerging markets and defense take a larger slice, reflecting a willingness to lean harder into those rotation themes for higher potential return and higher volatility. Whichever profile you're closer to, two disciplined pieces matter more than the exact percentages. First, decide your ranges in advance. For example, EM between 5 and 15%, defense between 2 and 7%, gold between 5 and 15%, depending on how worried I am. Second, commit to a rebalancing rule, like checking once or twice a year and nudging things back toward the middle of their band instead of reacting to every spike or drop. This way, when emerging markets rip higher and suddenly become 18% of your portfolio, your rule nudges you to trim a bit and recycle gains back into the core or underweight areas. When gold sells off and drops below your minimum, your rule nudges you to add a little, turning volatility into a buying opportunity rather than a reason to bail. The last piece is mindset. Core satellite strategies are not about finding one perfect asset. They are about admitting that the world is uncertain and then structuring your money so you do not have to be right about every detail. You're letting your core do the heavy lifting over decades, while your satellites quietly express your view that growth is global, security spending is sticky, and safe haven assets like gold are becoming structurally more important. If you can stick to that kind of plan, diversified core, clearly defined satellites, sensible ranges, and boring rebalancing, then it almost does not matter which headline is screaming this week. The rotation we have been talking about stops being a source of stress and becomes exactly what it is for big money, a slow, deliberate shift that you can quietly align with over time.